Hello, everyone. Welcome back to Small Business by the Numbers. My name is Peter Hansen. Today is a special SBET update. It's not just the July numbers. You'll notice something right off the bat. It's me introducing the podcast rather than our normal fearless leader, Holly Wade. The reason is we have a guest. Today I'm joined by Joanne Hsu, Director of the Surveys of Consumers at Michigan. Joanne, thank you for joining us.
It's a pleasure to be here. Thanks for having me.
So this is super exciting to me personally. I think it's really wonderful for the podcast. There are a lot of parallels and connections and shared history that create, I think, a tremendous backbone for this conversation. So just start with some of the really crazy kind of history connections here. Bill Dunkelberg, affectionately known as Dunk, the father of our survey here, he started his research career at Michigan. In fact, did his PhD there and worked in the Michigan Institute for Survey Research. Same department, same umbrella organization of Joanne's department. The SBET survey was inspired by the Michigan Survey of Consumers, and actually a little bit more by a survey called the SCF, which is what Dunk worked on at Michigan, a Survey of Consumer Finances. Well, the SCF moved from Michigan to the Federal Reserve Board, and Joanne worked on the SCF at the Federal Reserve Board. So another shared link there, and another shared link as well. I worked on the SCF at the board with Joanne. Joanne was like a really important mentor kind of in the very first chapter of my work career before she then went back to Michigan, Survey of Consumers. I made my way over to NFIB, so a lot of history there. Joanne, add anything that I missed about the connections, but share also what the Michigan Survey of Consumers is, but kind of from just like a high level before we kind of get into the numbers.
So one additional thread of connection is that the Survey of Consumer Finances, where we work together at the Federal Reserve Board and Dunk used to work at, that and the University of Michigan Surveys of Consumers actually used to be a single project, which branched out into two. So they have a shared history going all the way back to the 1940s. And then they kind of split off into two, which makes sense because one is a wealth survey and one is a survey of consumer attitudes. The wealth survey eventually went to the Federal Reserve Board. And here you and I are working on attitudes coming from two very different but overlapping parts of the economy, which is just so neat to be able to chat with you about that. So a little bit of background on what I do here. So, as I mentioned, the University of Michigan Surveys of Consumers started in 1946, back when I was, just a glimmer in my grandparents' eye, I suppose you can put it that way. But the University of Michigan is really where the survey was invented, particularly consumer surveys. So it's really the university's bread and butter, and I'm really proud to be working on this, 75 years on. I am an economist by training. I was trained right here at the University of Michigan. I also spent about 10 years at the Federal Reserve Board of Governors in DC as a research economist working on all things consumers, from research on financial decision-making among consumers to working on the consumer spending forecast and financial stability. And now I'm back in academia working on another important survey, the Surveys of Consumers.
Great. I want to ask you what the latest is you're hearing from consumers. But first, I want to run through the latest, what we heard from NFIB members in the July survey, data collected recently. And, well, frankly, it's quite a surprise. And the good news is surprise on the positive side. In the broader context of 2026, we saw a pretty sudden and meaningful downturn, fuel costs really pinching small businesses as well as their buyers. That held things on a lower level for a few months. I saw a bit of a tick back up in June with fuel prices starting to settle down, a little bit of positivity. July, the news maybe tougher in some ways than June, maybe similar in others. And, well, what you would expect perhaps was a similar result to June. Instead, Optimism Index up 2.4 points to 99.8. Quite a meaningful movement. 8 of 10 components up, with hiring plans moving up 8 points. That was the biggest, or 9 points, I believe, actually, the biggest single contributor to the index's increase. The uncertainty index was up 2 points. That's a little blemish of not as good news. The employment index was up just shy of 2 points, 102.1. That's the first increase since February. To add a little detail from the top issue question, labor quality rose up 8 points to 27. That's the top issue. The first time it's been that high since October 2025, and that's actually quite an interesting comparison in the context of SBET because when it was at 27 in October 2025, that was a surprise leap, very much as it is now. When it came out, we said, interesting, let's see what happens next time. And the next time, it went right back down to about where it started. So with this surprising positive data, I mean, there's good news. It's always great to hear positive feelings, sentiment, results as well, a part of our data. And then the question becomes, will this hold up? I think it's quite a strong question in this case because it's so surprising, puts a lot of pressure on and creates interest in August. So that's a really quick run through of the SBET side, the small business side with this surprising positive. Joanne, what are you hearing from your broad survey of consumers?
Generally, quite consistent with what you saw with small businesses in July. So for the last 2 months, consumer sentiment has seen 2 consecutive months of 10% or more increases. So May was very, very low as a result of the surging gas prices in the wake of the Iran conflict. Since then, over the last couple of months, we've seen quite a bit of improvement. 10% between May and June, and another 10% between June and July. Now, gas prices did start to tick up again towards the middle and the end of the month, but it was still considerably lower than the peaks of gas prices as we had seen before. That being said, I wouldn't necessarily call consumers optimistic at this point. They feel a lot better than May, but they were feeling really, really sour in May. And even now, they're about 11% below where we were a year ago. So overall, consumers are feeling pretty guarded about the economy, but they are feeling a lot of relief over the fact that gas prices just aren't nearly as bad as they were pretty recently.
Yeah, and I think when you talk about that level, that's where there's a contrast right now with the small business data. With that 2.4 increase on the Optimism Index, we've moved from below to actually comfortably above our long-term average. The employment index has stayed above its long-term average, but we've gone from just a sliver above it to now a comfortable 2.1 points above it. So I think you look at the small business data and it's clearly positive, not just in trajectory, but also in level. And that's a contrast. Joanne, also, let's talk a little bit bigger than just the short-term pains and shifts related to fuel prices, Iran war. Before that, after, hopefully things settle back to normal, what's still on consumers' minds? And what's keeping them up at night? What are they happy about, stressed about, et cetera?
The number one factor that's been on consumers' minds since 2021, so about 5 years now, has been cost of living and prices and inflation. So this month, we had 50% of consumers spontaneously telling us during the survey that high prices were weighing down their personal finances. And this is incredibly high. This measure was pretty much negligible before the pandemic. After the pandemic hit and we started seeing prices climb, inflation climb in 2021, 2022, this share of consumers blaming high prices for eroding their personal finances just really escalated, and it's remained high for the last 5 years. I do want to be clear that consumers can tell the difference. They do distinguish between high prices and inflation. We ask them specifically about inflation, that is the rate of change of prices, and we ask them where they think inflation is going in the future. And that peaked in 2022. It surged again amid the escalation in tariff rhetoric last year. But after both of those events, those inflation expectations started coming down pretty strongly. So consumers recognized that inflation was likely to slow. But despite their outlook that inflation was going to slow down, we didn't see any decline in the share of people saying, my living standards are being eroded. High prices are a major burden. So at this time, consumers are really focused on pocketbook issues, kitchen table issues. It's all about cost of living. Kind of the upside is that, consumers had been bracing for a slowdown in labor markets. They were expecting labor markets to weaken for most of 2025. That has only happened minimally. And so people who have jobs seem to feel fairly stable in them. But we have a lot of people who are quite worried about, for example, the young people in their lives, or people who are already unemployed not being able to find jobs. So, consumers are kind of worried about those two different sides of their budget. They're worried about prices. And then a far distant second is the stability of incomes, which seem to be stable right now, but consumers don't really feel like that income growth will keep pace with inflation, and that's something that frustrates them.
Great. So really interesting to hear about kind of that hierarchy and how one issue has had such staying power. I think probably each of us can relate to that personally on some level. I want to shift gears now from kind of like the content of what we're hearing from consumers, specifically, let's say small business included, kind of sentiment surveys in general, to kind of like the how, the so what. How should people, whether that's a policymaker, just an observer, Wall Street, how should they be using sentiment surveys? What insights are they providing to the public that's different from the more super hard, GDP, CPI, unemployment rate?
So the first thing I would note is that what we traditionally call hard data points, like the ones you've mentioned, they're all backward looking. And by the time that we see them, they're a month or possibly even a quarter out of date. So it's telling us where we were in the rearview mirror. What surveys about the outlook of the economy, sentiment, what people expect for the future, that's forward looking. So if you are trying to get a sense of what's happening in the economy, you can use those hard aggregate data points to see what's happening in the rearview mirror. And then sentiment and expectations numbers give you some light on what could possibly be happening in the future. The reason why economists care about things like sentiment is that, and policymakers as well, is there's a recognition that the actions that people, firms, market participants take, they're not just taking it based on what just happened in the economy. They're making decisions based on where they think the economy is going in the future. So if you feel more confident, you're more likely to spend more, you're more likely to take some financial risks, you might be more willing to start a business, and that's all based on projections for the future. And so that's why, no one has a crystal ball, but we want to get a sense of what are these decision makers thinking about. Historically speaking, since 1946, our collecting of consumer sentiment has typically been the case that when consumer sentiment is on the downturn, spending tends to slow down in the near future, and when sentiment is on the upturn, spending tends to be more robust. That relationship has weakened since the pandemic. So over the last 5 years or so, sentiment reached an all-time historic low in June of 2022, and a recession didn't follow. But at the same time, a lot of different economic relationships broke down in this period. So what's known as the inverted yield curve has been a very reliable leading indicator of recession, and that was indicating a recession for multiple quarters after the pandemic, and that never happened. The SOM rule is also a very reliable real-time indicator of recession, and that was triggered in the last couple of years, and a recession didn't yield. So, I think we're in a bit of a new world right now about how these economic indicators relate to each other. But I'll point to one thing where the relationships are still very strong. One of the reasons why policymakers care about inflation expectations, that is, where do consumers, or as well as firms and market participants, where do they think inflation is going in the next year, where it's going in the next 5 years? So if you follow the Fed, you might hear about a policymaker saying, inflation expectations need to be anchored. They need to be controlled. They really don't want people to internalize this idea that inflation is going to go nuts in the future. The reason is that if you are a consumer and you believe that inflation is going to be crazy next year or sometime in the future, you may shift your spending habits to make that big ticket purchase now. And if everyone does that collectively, shifting from buying next year to buying right now, that can make inflation get even worse. Or they may go to their employer and say, hey, I need a raise, inflation's going up. And if everyone does that, that's going to increase labor costs across the board. And firms, it is believed, will pass that on to their customers in the form of higher prices, again, making inflation a self-fulfilling prophecy. Now, we have actually a direct measure on the survey. When we ask people, is it a good time to buy a big ticket purchase? We ask them why yes or why not. And we've been tracking the share of people who said, you should buy something now because prices are only going to get higher in the future. So it's precisely measuring this inflationary psychology, this behavior, which is completely rational from an individual's perspective. But if everybody does it, it can cause problems for the economy. And when you look at this measure in the 60s and the 70s, every time it went up, a few months to a year or two later, inflation would surge. So that happened every single time we had an inflationary episode in the 60s, the 70s, and the early 80s. The difference looking at recent years is that this measure didn't really go up much at all in the post-pandemic period, like in 2022, 2023. So we didn't have that reinforcing consumer behavior that made inflation worse. And that's one of the reasons why inflation was able to come down, 2022 to 2024. Then fast forward a little bit to the presidential election, where the president-elect was making a lot of announcements of tariffs and was campaigning on the basis of raising tariffs. And so when that election was completed, a lot of people expected tariffs to be implemented immediately after the inauguration. And so we had a surge of people telling us on the survey, you better make those purchases now before the tariffs kick in and increase prices in the future. And indeed, if you look at spending on big ticket items in the fourth quarter of 2024, cars, durables like appliances, that went way up at the fourth quarter of 2024. So that is an example of a measure on our survey that it seems like a psychological measure. Is like, is it a good time or a bad time to buy something? We're not asking you if you actually did or did not buy, but it actually translated into exactly what people said was a good idea, which is go and buy it now before those tariffs kick in.
A very interesting story. I did not know that about that kind of like second layer of specificity on inflation expectations. I know you have like a question about rates in the future, but the actual really concrete question about like how you strategically think about buying. And that relates to the question, and this is really building on, and you've touched on this, but sort of there's a spectrum between really truly feeling-based, sentiment-based, abstract, let's say non-concrete questions, or even to question, what do you think of the economy overall? The economy is such an amorphous thing that we could define so many different ways, as opposed to, let's say, a more concrete version. What do you think of your personal finances? Or okay, inflation's a little bit more vague than like, what do you think strategically about purchasing big ticket items? That more concrete question. How do you think about this question? And this is particularly interesting, or a particular challenge, opportunity, maybe better to said, in the SBET, because SBET is more, it spreads longer along the sort of concrete to abstract perspective. SBET asks you, what did you actually do in terms of hiring in the past 3 months? What were your actual revenues, profits, et cetera? But then also, what are your expectations going forward? And then even as well, the like, let's say the most sentiment, feeling oriented, do you expect the economy to improve? So how do you think about, within your survey, within the metrics you look at, the value of the questions along that spectrum of really concrete, defined concept, et cetera, to, okay, this is a bit more vague, a bit more abstract. How does the value change along there?
So we have a range of different types of questions. We start with questions about personal finances because they're concrete. People generally have a pretty good idea of what we mean by when we say, are your personal finances better or worse than they were a year ago? It's well understood, and it really gives us, a bit of a snapshot of how people kind of conceptualize their economic situation. And it is true that when we ask people about business conditions, most of the people we interview aren't business owners, but they are clients of businesses, right? So they may not have any control over business conditions, but they have an idea based on their experiences in the world. And so the abstract, what you might call a vaguer question, in a way gives consumers a bit more latitude to incorporate all of the experience and observations around them. So you might consider questions about business conditions, particularly in the long run, like 5-year business conditions. Like no one really knows, but we ask them to give us their best guess, their best impressions. and we let them tell us why they feel one way or the other. But in addition to questions about business conditions, we have a whole plethora of questions that are much more specific on where they think their own incomes are going, their own probability of job loss, where do they think unemployment rates are going, inflation, big buying conditions for big ticket items, is a good time to buy or sell a house. Like these are all pretty specific, pretty concrete. And I think taking those questions together is what gives us a fuller picture of what consumers are thinking about, like what's weighing on them on one hand, what's giving them confidence for the future on the other hand, and gives us a lot of color. And that's what enables us to very confidently say that like the number one factor on people's minds is high prices, because it shows up time and time again. It's not just showing up with personal finances. It's also one of the top factors for buying conditions for big ticket items. Is it a good time to buy or sell a house? It's showing up in the type of news people are hearing about the economy. And, interestingly, in the post-pandemic period, not so much right now, but when we looked at 2022 to 2024, the share of consumers telling us, I've heard negative news about the economy related specifically to inflation, was twice as high in the post-pandemic period as it was in the 1970s, which is one of the possible reasons why this has really captured the attention of consumers so much. Of course, by the end of the 70s, consumers had been through multiple episodes of high inflation, so it was kind of like old news by then. But of course, as we all know, the news environment, information environment's totally different now than it was in the 70s, when everyone in your community might be getting their news about the economy in the same place, like the evening news, the morning paper, the same radio station, and so you might be getting it once a day. And now you're hearing about stuff related to the economy and news in general pretty much 24/7.
Yeah, a couple multipliers in there. I think one key point about a value of sentiment that is perhaps a little underrated, and you've alluded to this as well, as you take a concept like profit. You can ask someone what their profit is, but then you ask someone, well, how do you feel about your profits? And that adds a lot of information that, okay, is that number good or bad? Well,
Yeah.
how did it compare to expectations? How did it compare to plans? How did it compare to goals? And that's where you get something, okay, like maybe it's a little bit more vague, it's a little tougher to handle, but it's capturing something in a way that such a concrete number will miss. Now, another question to kind of like compare ourselves here a little bit. There are ways that consumer sentiment and business sentiment differ. Maybe we've been moving in parallel to a certain extent in recent months, but businesses, their level has been more optimistic than what you have seen in your consumer data. How should folks think about that? Is there a reliable rule when business sentiment and consumer sentiment differs, case by case? What should we be thinking about right now?
So first of all, we shouldn't expect them to be the same, and we shouldn't even expect them to move together much of the time. I mean, they're consumers and business owners. Well, business owners are also consumers in different parts of their lives and vice versa, but they're really thinking about different things in the economy, right? Like, and what's good for a business may be also good for some consumers, but not others. And likewise, I'm sure you see also quite a bit of heterogeneity across business owners. So, I mean, I think where they largely intersect is on the labor market, in terms of, how much confidence firms have to continue hiring or to expand their labor force. That directly translates into jobs created or jobs lost for workers. But I think the other thing that I will also point out here is that we see a lot of variation in consumer sentiment by demographic group. One of the things I've been watching very closely in recent years is differences by wealth. So, if we've talked about how consumer sentiment has been very, very low these days. That's largely driven by people with low wealth, whereas higher wealth people, their sentiment is doing much better now than it was in recent years. And a question I get is like, how can consumers feel so bad when the stock market's doing so well? Well, if you don't own any stock, it doesn't help you if the stock market's doing well either. And when I think about businesses, different businesses are interacting if they're consumer facing, they may be interfacing with different types of consumers, wealthy consumers or less wealthy consumers. And so one of the reasons why aggregate consumer spending or GDP has been really strong is that wealthy consumers generate the lion's share of aggregate spending. On a survey, it's only one person, one vote, but with an aggregate number like GDP, it's $1, one vote. And if you have large stock portfolios, what we see in our data, your sentiment is much, much higher because you're being, even though you hate high prices too. So let's be clear, everybody, including the rich, hate high prices. But at least if you're wealthy, you're getting some support from this surging stock market. I think we maybe hit another record yesterday or today. But for those households in the economy who have minimal stock wealth or no stock at all, it doesn't matter to them whatsoever.
Yeah, I mean, I think that's a great point. One of the realities of NFIB's collection of members who are part of our survey, they run the gamut on all industries. They're all over the country. They're everybody. And one of the implications, relates to my next question, which is I want to talk about the political bias angle. I know this is something that you've heard a lot from a lot of people about. How much would you say of the signal in the Michigan survey is partisan? What does that mean for how well kind of the value of your headline metrics holds up? I mean, to what extent as well is partisanship like a feature? Like it's useful to know about partisanship and how that colors sentiment? To what extent is it a bug? Like, oh, this is a problem and something you want to throw out?
That's a great question. So, the truth of the matter is that partisanship is something that shapes our views of a lot of different things in the world, and the economy is just one of them. And this shouldn't really be surprising because candidates, all types of politicians at all different levels, they will campaign based on economic policy and they are proposing different policies depending on their beliefs about what's best for the economy. So, it shouldn't really be any surprise that consumers and voters and business owners will also disagree on whether a particular policy is going to be good for the economy or bad for the economy. What's really interesting is going back to at least the Reagan administration, it's always been the case that if you are part of the party that's in the White House, you tend to feel more favorably about the economy than someone who doesn't. And again, this and independents are right in the middle. And this makes sense because presumably you may have voted or may have preferred the person who's in the White House because you think their economic policies are better. So it completely makes sense that if your person is in the White House, that you think the outlook for the economy is better because you think the better policies are going to go into place. So I think this is absolutely a feature and not a bug. More evidence for this is that there's a lot of research out there, published academic research that shows, these partisanship alignment of views actually translates into behavior. So as an example, people tend to spend more when their person's in the White House, when a person of their party's in the White House. And that is true for Democrats, it's true for Republicans, and it switches when there's a change in the White House. We actually also see this with small business formation. Republicans are more likely to start a new business under a Republican president, and vice versa for Democrats. And we see this with patent applications. We even see this with tax evasion, which completely blows my mind. So given that there are partisan differences in how people behave depending on which party is in the White House, I think we would be remiss if we were seeing the same number of sentiment coming out by political party. That being said, it can be a little bit alarming to see how much people disagree. But when you look in the data a little bit more closely, you realize that aside from presidential transition periods, like when the White House is changing hands, besides those couple of months between the election and the inauguration, actually independents, Democrats, Republicans, they all move together. They all go up together, they go down together. So the last couple of months after gas prices started to ease up, members of all three political groups, their sentiment improved. So this wasn't something that was just being driven by one part of the political spectrum or the other. And moreover, if you just think that like, hey, I'm still not convinced, I think that partisans are just, I don't believe what they say, that's fine. You can throw out all the Republicans and all the Democrats in our sample and only look at independents. And actually, if you do that, those numbers are exactly the same as our national estimates. And that's been the case for years now. And so the national measures are perfectly aligned with independence. So, if you want to slice it in that way, we encourage our data users to do so. And it's just very, very clear that our results are not being driven by one part of the political spectrum or the other. But, we're a university, we want to be transparent. And so we put all of our data out there. So if people want to do something else with the data, so if they want to say, I only want to look at certain kinds of independents, or I want to look at people at this very specific slice of the population, we put all the data out there for people to slice and dice it as they like.
Yeah, and I think you made a lot of important points in there. And one I just want to emphasize, especially from that small business perspective, is how people have their political views in substantial part because of policies that they think are right. If you're a small business owner and you have a certain suite of problems, whether it's labor quality or inflation or taxes or regulation, and a different political leader, one that you favor or one that you disfavor, comes into office, well, you're going to make some predictions that there's a good chance that they'll have some truth to about what's going to happen with those issues. And then you're going to predict how your business is going to fare as a result of whether those issues get better or worse, and probably invest in or not invest in your business as a function of that. So I think that really valuable perspective of just because sometimes it'd be surprising to see the scale of the impacts doesn't mean that there's not a clear reality there. And I think, one thing I'm really grateful for in SBET is the variety of questions that we have. And there's even a hard versus soft version of our Optimism Index. And one shows the soft one it is specifically. It shows a bit more of that movement related to a presidential election, and the hard. So just like you say, our data is freely available to everybody. And if you're like, okay, I believe some of the movements, but then, an election happens and that's crazy. Well, you can pick your own idealized version, subsets that will probably parallel quite substantially the overall headline metrics that we use, but have slightly different behavior that maybe you find a little bit more convincing if you want to filter out some of political sentiment, whether you appreciate it or not. Two more questions. Maybe we'll do them kind of quick. They're shorter, less meaty. First of all, I know you started to not collect a new question, but kind of draw out some data on AI in your survey. Why are you doing that? What are you seeing?
So we have many different places where consumers can speak freely about a particular topic without us leading them. And so one of the things I've been interested in is how people are conceptualizing the role of AI in the economy. I started looking at this last year, and beginning of 2025, basically nobody mentioned AI. Something like 1% or less of consumers mentioned AI. And fast forward a year and a half, and that has gone up tenfold. For multiple months now, we have more than 10% of people spontaneously mentioning AI. So this is an enormous shift that we didn't see, even a year ago. And so what's really interesting is that these mentions of AI, they take a few different forms. So you have some people who are saying AI is driving productivity gains, efficiency gains. It's doing great things for my stock portfolio. And that's kind of the optimistic side. And then we also have other consumers who are really worried that AI might cause job loss. That I'm really, really worried about the young person in my life who is struggling to find a job, and I think it's because of AI. And then still others are worried about, data centers. There are many people who are specifically mentioning data centers, and most of those data center mentions are worried about what's going to happen to electricity prices or possible damage to water supplies or the environment. And so these AI mentions are really running the gamut, though at this time, on balance, it's fairly negative. The folks who are saying this is driving efficiency and productivity gains, those folks are in the minority right now. And all that being said, this is a little over 10% right now. This is still being swamped by the people who are talking about gas prices. So, almost 40% of consumers, or just prices in general, weighing on their personal finances. That's half. So really, these concerns over AI, they have grown tremendously over the last year, but in the last few months, it's really been swamped by gas prices.
Interesting perspective there. I mean, I think it's sort of like the quiet niche growth that people who are really paying attention to exploding into the broader sphere. But at the same time, I say exploding 10% is so much smaller than 40%, right? It's starting to touch lives, but still kind of small in a certain way.
I would say that 40% is enormous on our survey. It's like pretty
Yeah.
much impossible to get 40% of people to agree on anything. So I think the moral of the story is to be like, people really hate high gas prices.
Yeah. Okay.
And then the 10%, historically speaking, is still pretty high. But
Oh, okay.
man,
Nice.
people
So a substantial
hate.
factor.
Yeah, it's a substantial factor, but people just universally hate those high prices.
Yeah, I feel that. Final question. Let's look forward. What's on the horizon? And I think in particular, like what in your data are you watching that maybe not enough folks are paying attention to, that you don't get asked about enough as you look into the future, the next 12 months, the next 5 years even?
So I think one of the main things on our survey, I'll mention two things. So one I've already talked about, which is differences by income and wealth. I think, we are one of the very few surveys of consumers that really have anything to say about differences by wealth. And given how much spending and aggregate economic activity is being driven by the wealthy, I think that when we think about the state of the consumer, it would really be remiss not to look at that heterogeneity, to look at those differences. And I think, your NFIB members are probably perfectly aware of this because different firms are serving different parts of the population, and they're probably, some are focused on wealthy, some are focused on not. So that's something I'm trying to convey, that like aggregate numbers can really obscure quite a bit of disagreement under the hood, or differences in economic outlook. Specifically in terms of, things I'm watching on the survey, labor market measures are the ones I'm watching the most closely. Because as much as people complain about high prices, what we have seen is that they are still willing to spend if they feel like their incomes are reliable. We haven't seen, massive job losses or a really marked weakening in labor markets in the last few years. So even though we have these 50% of consumers complaining about prices in general, 40% complaining about gas prices specifically, we know a lot of consumers are pulling back, that they're trading down a lot of their spending, but they are still willing to spend, particularly the wealthy consumers, because they feel like their incomes are stable. So if labor markets start to weaken, if people start to feel like their incomes are precarious, I don't know that spending can really be sustained. And that would especially be the case if we see any sort of downturn in the stock market. And so what's good news for the economy is that if the stock market continues to do well, or continues to post strong values, then the people who are responsible for most of the spending are probably going to continue to be willing to spend. And that could keep the economy running in a way that wouldn't be possible if everybody kind of pulled back their spending because they felt kind of financially precarious. So I think the heterogeneity across the population is really important, and specifically how people feel about their incomes, because this economy has just enjoyed a pretty strong labor market over the last few years, and that is something that could change pretty quickly.
Well, really interesting point about the heterogeneity. A little nervous to think that we're all maybe a little bit more invested, relying on the stock market, famously volatile, than we'd want to be. Hopefully it stays where we need it to. I want to close with sharing a lesson I learned from you in my first years at the Federal Reserve Board. I think it's actually perhaps one of the most important lessons I've learned as a researcher, which is to walk a mile in their shoes. As economists, you get a piece of data, some decision that, a consumer, maybe someone low income made, and you think it doesn't make sense. Why did they take out that payday loan? And it's something that you really emphasized to me back when I was learning from you so much the Reserve Board is, well, take a pause and understand, walk a mile in their shoes, like understand what they're coming from. Just because a behavior pattern doesn't fit your model doesn't mean they're making a mistake. If you see that discrepancy between what you expect based on your way of thinking and how people are behaving in your data, if you put a lot of extra effort into trying to understand what don't you know, how is your thinking wrong? I think the vast majority of the time, 3 times out of 4, 4 times out of 5, 9 times out of 10 even, you're going to figure out actually their decision makes a lot more sense. And now you're going to think about the economy. You're going to think about how they're thinking. in a smarter way that gives you better insight and allows you to make better predictions than if you're confident in your initial model and confident in the way that you're thinking and you're saying, these foolish consumers, or, these people, this decision doesn't match my stylized model that I'm thinking about as an economist. And that's a mistake. And it's been really valuable for me to put that extra effort in to say, wait a second, how is my model wrong? How are my assumptions wrong? And then see what falls out of that effort. So thank you for teaching me to go that extra mile to understand their perspective. I think it's wonderful you're still doing that, representing the consumer. I'm doing my best representing the small business over here. And thank you so much as well for joining us on Small Business by the Numbers. Wonderful having you.
Thank you so much. It's been such a treat.